couple of years ago, they paid a $960 million fine.
Yep.
Almost $1 billion.
Yeah.
And when they asked the guys, like, yeah, but we made 20 billion. So it's just like a cost of doing business. It's like a 5% tax.
Mm-hmm.
And the SEC loves it, right? Because they're funded by their fines. That's a crazy thing. They don't get government funding. They fund themselves by fining people.
Police for profit. Yeah.
They like to fine crypto people.
As the economy hangs on the verge of a possible recession, it seems that Bitcoin, the first cryptocurrency, might be set for its next big and potentially explosive rise in the financial markets. This is the latest information shared by Mark Yusko, the respected founder and CEO of Morgan Creek Capital Management. Recent GDP numbers have revealed a surprising drop, falling sharply from a steady and hopeful 4% growth rate to a concerning negative 2.8%. This might signal potential economic difficulties ahead. This major and sudden drop in economic indicators may require quick and strong action from policymakers to reduce the negative effects and bring stability back to the economy. To address a time of economic downturn like a recession, the Federal Reserve would likely lower interest rates and add more money to the financial system, steps that usually lead to higher inflation levels. Since the supply of Bitcoin is limited and cannot be increased in response to more money being circulated, its value in US dollars could increase dramatically to new heights. Economic downturns can be tough and present big challenges. However, it's important to remember that this situation might actually provide a big opportunity for those who have decided to invest in Bitcoin. Make sure to watch until the end of the video presentation, as Mark Yusko will share many important insights and useful information that you don't want to miss. If you enjoy keeping up with the latest financial news and trends, we invite you to like and subscribe to our platform. It is totally free, and you can change your preferences whenever you want. Now let's dive back in and hear the valuable ideas from Mark Yusko.
I think you have to really think critically about market participants the way you just outlined. The subtle thing is, while the numbers are down, the number of block rewards are down, the price is higher, so the value that's getting bought and sold continues to increase. And so while I totally agree with the point that the miners have less incremental control, and then there's a second sinister part to this, which is what we've been talking about as spot. But most of the nastiness of the last year has nothing to do with spot. It has to do with futures.
Right.
And see, this goes all the way back to that 2017 period. So in 2017, there was, all this ICO stuff and all, craziness, and Gensler's cracking down, and, everybody's, that's pre-crackdown, and everybody's getting upset. And there's this guy, Leo Melamed. Leo runs the Chicago Mercantile Exchange. And had this quote in 2017, which I thought was really strange, but now prophetic. And he says, "We will tame Bitcoin," which is a very interesting word to choose, right? Like, that's an active choice. We will tame. And he's like, we, the CME, we institutions, we, Wall Street, the dark side. Well, what did he mean by that? Well, what he meant was, when Bitcoin was deemed a commodity, everybody's like, yay, we're not a security. Be careful what you ask for. You might get it. We would have much preferred to be a security. Why? Well, because by being classified a commodity, now Leo and crew can create futures on our product. Well, why does that matter? Well, Bitcoin is something that can only be created, not out of thin air. Not true. A futures contract can create Bitcoin out of thin air, just like it creates oil out of thin air or wheat or corn. And what does that mean? Like in the old days, if I had oil and I wanted to sell to you, right, I had to physically have it or have title to get it. Well, then the futures came along and said, hell to the no. I can just write a contract with you. And as long as we settle the contract before the delivery date, I don't ever have to have any oil. That can just be a financial transaction. So you get these very weird, if you look at oil market, right, it'll go way, way up high and then it'll crash and then it'll go way, way up high and it'll crash. Well, in those big peaks and big crashes, what happens is the imbalance between paper and spot becomes very, very large. Well, remember 2017? I remember it to the day. December 18th was the peak.
Yeah.
Now, why was that the peak? Because that was the day they launched the futures, which allowed institutions to go naked short and push down the price. So we went from 20 to 10, and then from 10 to 6, and then from 6 to 3.
Right.
And people said, oh my God, it's dead, it's over. Wasn't over. So fast forward to last year, January 10th, everybody's like, yay, Bitcoin ETFs. I'm like, yeah, is anyone else watching this? The freaking CME approved a slew of new futures contracts. And so what drives me crazy, every 45 days or every 90 days when the 13Fs come out, everybody reports, oh, Millennium bought $2 billion of Bitcoin. No, they didn't. Yes, they own $2 billion of IBIT, but they're short at least $2 billion, maybe more. Yeah. Usually they're market neutral, but maybe sometimes they're even net short. Because the futures price is always higher than the spot price. And so over the 30 days, you roll down the curve, and that's called roll yield. And that's why if you buy any of these commodity ETNs or ETFs, you lose money every single day because you're just getting destroyed. So it's, again, a long answer to saying what's happening is there's very, very big money, to your point on the institutions, that is shorting the crud out of futures with reckless abandon. This is what happened with gold. When the gold ETF was approved, it took over a year for GLD to get back to its issue price because they were spoofing the futures. And JP Morgan, I love this part. So in the gold market, JP Morgan does something called spoofing, right? They pretend to have interest and then they pull back the bids right at the end and they push the price artificially down. It's against the law. You get fined. A couple of years ago, they paid a $960 million fine.
Yep.
Almost $1 billion.
Yeah.
And when they asked the guys, like, yeah, but we made $20 billion. So it's just like a cost of doing business. It's like a 5% tax.
Mm-hmm.
And the SEC loves it, right? Because they're funded by their fines. That's a crazy thing. They don't get government funding. Uh-huh. They fund themselves by fining people.
Police for profit. Yeah.
They like to fine crypto people.
To manage the ever-increasing debts, central banks have relied on printing money for decades. A significant number of these debts are the result of promises made by previous generations that were not fulfilled. This strategy has resulted in a massive burden of debt, which has compelled the Federal Reserve to continuously increase the amount of money in circulation in order to maintain the buoyancy of the economy. Since the Federal Reserve was established in 1913, the value of the United States dollar has steadily decreased due to inflation, which has gradually made people's savings less valuable. Mark Yusko elucidates the reasons why Bitcoin is of such critical significance in this context. Bitcoin, in contrast to traditional currencies, cannot be printed and distributed indefinitely. Because of its fixed supply, its value is not continuously depreciated by inflation as it would otherwise be. Despite the fact that the purchasing power of the dollar lessens with each passing year, Bitcoin continues to maintain its stability, making it an increasingly appealing alternative. To put it another way, The more unstable fiat currencies become, the more attractive Bitcoin appears to be as a trustworthy resource for storing value. First, let's go back to Mark Yusko and hear some more of his insights.
And I think you can have both, right? As gold is the only asset that's both a money and a commodity, right? Has commodity uses, industrial uses, but it's also money. And everyone talks about, we just hit $3,000 in gold, and now there's 20 trillion. Half, 10. So 10 is the monetary part, the bars and the bricks and stuff in the vaults. The other half is jewelry and chalices and gold leaf on the dome. And so that doesn't really count because you're not going to, barter the jewelry very often. But that monetary value, 10 trillion, to me, that's what Bitcoin basically replaces. It's a better form of gold for money as the base layer in the future because it's more divisible and more portable. Beyond that, then it gets to, well, how do we replace these currencies that are out there backed by debt? That gets a little dicier, and the nation states are going to fight that. But ultimately, I think we can exist if there's a financialization above the base layer. I think, because you can always choose to self-custody and hold directly, or you can choose, the boomer wrapper of the ETF, or you can choose the financial instrument like a future. And the key there is, like I said, adoption, right? It's getting more participants involved, because the thing that bothers me about this recent downturn, it's on no volume, right? Oh my God, there have been outflows for 5 weeks. Yeah, how much? 5 billion, 6 billion. I mean, that's not a lot relative to 1.8 trillion. Well, then why is the price moving so much? Because of this financialization. And the thing that the people have a hard time with, and this is true of any asset, right? Think about NVIDIA stock. How much money did NVIDIA actually raise when they went public? Okay, not that much. How much is the value of that stock? What do you mean value? Because here's the thing. You're taking the price of, if you and I trade 100 shares, we'll get that price. And we're multiplying that by the billions of outstanding shares and getting a market cap. But here's the problem. If I had 1,000 shares, I'm not going to get that price. If I had 1 million shares, I'm not getting close to that price.
Yeah.
If I had 1 billion shares, I couldn't sell them. Traction has to be liquidated. Mark and Elon own a bunch of Doge, right? At least that's what we think. And on paper, it's worth a bunch of money. No, it's not. Because the minute one of those two wallets sells one Doge, that price is collapsing.
Yeah.
It's going to collapse. And the only way is if you feed the ducks, right? If you are feeding into that frenzy of the money coming in, XRP comes to mind, which... it's
that
amazing.
Knife cuts both ways, though. The previous cycles, man, they weren't feeding the ducks; they were pulling back because they were selling ducks.
I don't know exactly, but it's amazing how people still don't understand that if a foundation or an individual owns the bulk of something, and they're selling it to you, they're not on your side. Literally. You are their exit liquidity.
Yeah.
And it's, I meant the most egregious example of that was there was this consulting company that went public in the dot-com boom. It's a husband and wife team out in California. They floated 1% of the company. That thing would trade 40 times a day. The whole market cap would turn over 40 times, and they would just feed another 0.5% every day until they eventually sold this worthless company, which helped companies change their name to .com. I mean, there was literally no there. and they got super rich and everybody lost money.
Mm.
And that, again, that's a story as old as time. I mean, free and fair is the only, if look, I'm not a big believer in meme coins generally. It's monetizing attention. I'm like, no, it's a Ponzi scheme, just like all Ponzi schemes, and that's fine. You want to do a Ponzi scheme, knock yourself out, but don't tell me it's some newfangled thing.
Yeah.
It's just this month's edition of what's popular. Okay, but you're not creating any value, and it's part of my struggle. So whenever I talk, Bitcoin to Bitcoiners, like, oh, you're a shit coiner. Like, what are you talking about? I own more Bitcoin than you do, probably, and not you personally, but most people I talk to. And they're like, no, you own Ethereum, you own Solana. I'm like, yeah, so what? Well, then you're a shit coiner. I'm like, no,
I'm objective.
I'm objective, and I one, I like to make money, and two, I believe that there's a role in the world for smart contract technology. I believe that. Now, whether we know how it's going to work, but what I don't like, I love the construct of Uniswap, a decentralized exchange where we control. I love that. Not centralized, not New York Stock Exchange. What I don't like is that the token doesn't share in the revenues of the DEX. And they even know it, right? They've been trying to do Uni 2, and they get close, and again, I'm not criticizing anybody because that's what the ICO thing was. But just because you can issue a token with no claim on equity, no share of debt, no share of cash flows, doesn't mean you should.
Mm-hmm.
And just because you can launch a pre-mined meme coin where you own 80% and you feed the ducks doesn't mean you should. Like, I have one meme coin, dog, go to the moon, right? How'd I get it? I got it because it was airdropped to me because I did some ordinals, and I love it, right? It was free and fair. Everybody that had a certain thing on a certain day got some.
Yeah.
They didn't keep it for themselves. Now, maybe it'll go to 0 too. I don't think, I don't know, but that, at least to me, has a chance of being okay.
According to Mark Yusko, there are 3 key components to successful investing. The first is the liquidity bucket, which is where you should keep 5 to 15% of your portfolio in low volatility, easily accessible assets. By doing this, you can avoid having to sell off investments at the wrong time and guarantee that you have enough money to pay for regular expenses like housing, food, and bills. The growth bucket comes next, where 10 to 15% of your portfolio is devoted to riskier investments like speculative stocks, private ventures, or creative startups. These investments have a greater likelihood of failing, but they also have the potential to yield sizable profits. Lastly, the majority of your portfolio, roughly 70%, is made up of the wealth preservation bucket. Higher volatility, diversified assets such as commodities, real estate, private equity, and digital assets like Bitcoin fall under this category. Yusko contends that due to their poor returns, bonds aren't the best choice for this category, particularly for younger investors. Bitcoin, on the other hand, is perfect because of its low correlation with traditional markets and historically strong performance, which lowers overall portfolio risk while increasing long-term growth potential. Before we conclude, make sure to sign up for my daily 5-minute crypto newsletter if you want to be informed about the most recent developments in Bitcoin and cryptocurrency. More than 50,000 investors who are searching for the most up-to-date information trust it because of its expert predictions, breaking news, and superior on-chain analysis. The description below contains the link. Thank you for listening. I hope you found value in today's video, and I'll see you in the next one. I hope the best for you.